Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. It is September 23rd of 2022. Now we're recording this on a Friday. It's going out on the Monday. But what we wanted to do this week is really kind of review everything that's happened this week. And we're calling this presentation Defense is Offense, because if you've been in our portfolios, you know over the last month and a half, we used that bear market rally to offload risk, to introduce hedges into the portfolio, to go short the market. And largely speaking, that has started to really play out to our advantage. And for the foreseeable future, we're going to continue to play defense. And so let's go ahead and get started as it relates to this week's presentation. And this is really simple, ladies and gentlemen. The Fed has made it clear. They are going to deliver pain. And Jerome Powell has said those specific words, that there is going to be pain in this adjustment, and that they are clearly looking for asset prices to move lower. When they made those remarks at Jackson Hole, we took them seriously. And so we're not going to fight that Fed. So three things we're going to go through this week. We're going to review the most recent FOMC decision as it relates to last Wednesday. What does that mean for your money, both short and long term? Number two, understanding the impact of higher rates into a slowing environment. This is not something we've seen since the early 1980s. So we got to change the rules as it relates to portfolio management and how we approach risk assets. Lastly, what do the leaders of the market tell us about the whole market as a whole as we go into the latter part of September and the month of October? So Fed Day, what do? They increased interest rates on the short end by 75 basis points. Here's all you really need to know. Interest rates are going up larger, faster, and they're going to stay there for longer. And they're doing that into an economic slowdown. So they're draining money supply, they're increasing interest rates into an economic slowdown. This is the reverse of the Fed policy actions in 2008 and 2009. This is reverse QE, right? Reverse money printing. What did money printing do for asset prices? Sent them up. What happens when money supply goes down or you burn that cash supply away? We think asset prices go down, right? Now, how long that holds up for, we don't know. But so long as this current regime is in place, we are going to keep these rules in place. So we can see here on the day they made that announcement, someone here decided to short cover some futures, but then as soon as the words became clear, larger, faster, and for longer, we saw a big rollover in S&P futures. This dot plot, the green line, represents where FOMC members expect interest rate policy to be. The market was looking for about 4.1 to 4.2% in early 2023. We got 4.6. That is significantly larger than expected. So asset prices have to adjust to this new reality. And we're living in an inverted world. When we look at the yield curve, specifically the 210 curve, it has become the most inverted that it has ever been. The yield curve is now more inverted than it was leading up to 2008. And this is concerning, right? In the summer, we did not have a lot of these conditions in place. We now do. We have a tightening Fed into a slowdown, and that tightening is accelerating. So we have to be careful. When the yield curve is this inverted, that is a sign of danger. And that accident risk becomes elevated. This is the fastest rate of change ever in terms of Fed policy rates. We've gone from 0% to 3% in record time, and we're going to 4 and beyond by the end of the year. That is what the Fed has told us. Now, could an economic accident or crisis overseas or domestically change that? Of course. But as it relates to today and what the market is looking at right now, is that FOMC policy are going to take interest rates to 4% and above, no matter what, unless something truly awful happens in the system. We're not saying I mean, that is a possibility, right? And we're going to go through that here in a second. This is the largest pace of interest rate increases since the early 80s. We can see the early 80s here on the left part of the chart. And stress is definitely building. Three metrics here I want everyone to pay attention to. One is the Japanese yen. The second is the European euro, the euro. And lastly, junk bonds. What we can see here is a dramatic sell-off in the currency market. So whether we're looking at British pounds, guess what? British pounds are getting pounded, right? We look at British gilts. Those yields are up 30 basis points in one day, a true panic taking place in the British bond market or in the British gilt market. We look at the euro. The euro is through parity, 97 cents. I heard someone say today, I thought it was a great line. It's that, hey, it's no longer called football, it's called soccer now. Until we get back through parity on that euro, back above one, we're going to, the US dictates the term of soccer, it's going to be called soccer. And then lastly, the Japanese yen continues to weaken. We've gone from 100 to 145. So in other words, the higher the number, the more yen it takes to buy $1. We've seen a huge sell-off. So we reverse these charts to show the depreciation of these currencies, just a dramatic depreciation across the board. And that has bled into the credit markets, junk bonds, a dramatic sell-off. Investment grade corporate bonds have now reached their COVID lows. That's important. So Facebook, those types of assets, those large cap, mega cap tech have reached COVID lows. We've got junk bonds approaching COVID lows, and we've got investment grade bonds at COVID lows or below. Why can't stocks do that, right? So it's a time to be careful. When the rules change, we're going to change again with them, right? That was a mistake that we made in the first part of the year. We're a math-based shop, and we're going to stick to being a math-based shop. And right now, we have to play defense. We are net short the market right now. So what do we look at? We want to look at the leadership of the overall stock market, right? Microsoft and Google, two of the biggest companies in history, two of the biggest companies in the US and the stock market, they're all at 52-week lows. So before the sell-off on Friday, these two stocks were at 52-week lows, okay? Everyone was debating, are we going back to June lows? Are we going to go through June lows? None of that matters. We own stocks, right? So are the stocks going to 52-week lows? Meta, Google, Microsoft, NVIDIA, all of these stocks that are very widely owned because they make up such a big chunk of the index are all at 52-week lows. We think Apple's next. Almost everyone that owns an index fund owns these stocks in size. So what happens when selling starts there? To give everyone an idea, when you look at some of the largest index funds out there, the Vanguard Growth Fund, the iShares Russell 1000 Growth Index Fund, the S&P 500 Growth Index, the top 5 growth stocks, Apple, Microsoft, Google, Amazon, and Tesla, make up over 40% of the index. So what happens when these investors get their 401k statements in September, or at the end of September and into early October, and see they're down massively, right? Over the last month, 2 months, year to date, et cetera. They will start selling. And when they sell the index, guess what gets sold along with it? The components of the index. And these components are heavily concentrated. We can see here, when we look at a value index, the top 5 components only make up 17% of that index versus 45% for the growth. That's why we think that the leadership of the stock market is most exposed to this phase 2 of the bear market. And so as the leaders go, this is where the S&P 500 was, again, not including Friday. We have to adjust that back down a little bit. But we think that the NASDAQ and the S&P catch up to those individual components already hitting 52-week lows. And then lastly, I would point out Bitcoin and Meta. A lot of people still own Bitcoin. We do not, of course, own Bitcoin. If anything, we would probably like to be short Bitcoin. But when we look at Meta or Facebook, it has gone through the 2020 COVID lows registered in March of 2020. Bitcoin in March of 2020 was around $4,000. It currently trades around 18,500 as of the end of day Friday, 19,000 if you're looking at Thursday. There is no reason that if Meta, which is a high quality, high free cash flow generating company, can go back to its COVID lows, that the center of the risk storm right now, the bubble within the bubble within the bubble, crypto, why those can't go back to COVID lows. We think there is significant downside in crypto, and that's the center of the storm. If there is an area to be short, and if you can stomach the volatility, I mean, Bitcoin is it. So that's where, that's why we're careful, right? And that's why we're cautious right now. So we do believe that stress is building across credit and the FX market. The FX markets being, of course, those currency markets, whether we're looking at the euro, the British pound, the Canadian dollar, the Japanese yen. They're all following the British pound and getting pounded. We think that now is not the time to be a hero. Don't try to catch a falling knife. It's okay if you leave a few percentage points on the table as markets bounce. It's a time to play defense. We're beginning to broach those June lows. Volatility is still in the high 20s and low 30s area. We haven't seen that blow off top as it relates to capitulation and fear. We do think that a major storm is potentially brewing in the currency land. If the Japanese blink and they go away from QE, Japanese bond yields right now are at 0.2%. Remember, 2-year yield in the US is at 4. The 10-year is at 3.6 or so. What happens if that Japanese bond yield screams from 0.1 all the way to 2 in the blink of an eye? That's not good news for China, because all that capital is going to flood out of China and go back into Japanese bonds and into US Treasury bonds. Not good for China. Not good for a lot of risk assets in Asia and Europe. Lastly, our portfolios are net short across the board. Whether we're talking the opportunity, the blue chip, the income, preservation, we're net short stocks across the board. And we're going to remain so until we see truly capitulatory selling. We'll manage those hedges quite actively, going up and down along the net short curve. But as of now, we do not currently see any signs of panic. So that's what we have for you this week. The number is 888-543-3776. Have a fantastic weekend, or I guess you'll be watching this on Monday. So have a great week. And again, if you have any questions, please reach out to your advisor or our offices. Thank you again, and have a great week.